As an employee in Canada, you may have been granted stock options by your employer as a form of compensation or as a bonus for your loyalty and hard work. Stock options offer employers an opportunity to motivate employees to work towards increasing the company's value, leading to potential profit for both employees and the company. However, taxation of stock options for Canadian employees can be complex, and it's crucial to understand how they may impact your annual tax return. This article will discuss the key aspects of stock option taxation in Canada, including tax rates, tax treatment, and reporting requirements. Stock options grant employees the right to buy company shares at a predetermined price, known as the exercise or strike price. Employees are considered in the money when the current market value of the share is above the exercise price, and out of the money when the market value falls below the exercise price. The difference between the exercise price and the market value is considered the profit or gain made from exercising the stock options. Knowing the tax implications of exercising stock options is essential to maximize the benefits they may provide employees. When an employee exercises stock options in Canada, the tax treatment will depend on whether the options are considered eligible or non-eligible. The Canada Revenue Agency, CRA, defines eligible stock options as those granted by a Canadian-controlled private corporation, CCPC, and held for at least 2 years. Non-eligible stock options are those that don't meet the CRA's eligible criteria, typically issued by larger public companies or non-CCPC organizations. The tax rates on stock options in Canada vary based on the type of stock options and the employee's income. For eligible stock options, the income tax rate is only applied to half of the profit made from exercising the options. This is known as the stock option deduction or the capital gains-like treatment. In contrast, for non-eligible stock options, the entire profit made from exercising the options are fully taxable as employment income and subject to the employee's marginal tax rate. It is helpful for both employers and employees to understand the tax implications for the employer granting stock options. In the case of non-eligible stock options, employers cannot deduct the stock option benefit granted to employees as a business expense. However, employers may be eligible for a stock option deduction when granting eligible stock options to employees. When an employee exercises non-eligible stock options, employers are required to withhold and remit taxes on the stock option benefit to the CRA. This is similar to the withholding requirements for regular employee wages. On the other hand, employers are not required to withhold taxes on eligible stock options, unless the employee specifically requests it. Stock option benefits must be reported on an employee's annual tax return. For eligible stock options, the benefit is reported on line 24,900 of the personal tax return and is eligible for the stock option deduction on line 24,900 as well. This means that only half of the benefit is taxable. For non-eligible stock options, the benefit should be reported on line 10,100 as regular employment income, and no deductions are permitted. Understanding and planning for the taxation of stock options can help employees make informed decisions about when to exercise their options and how to report the gains or benefits. Engaging a knowledgeable tax professional who understands the complexities of stock option taxation can be a valuable asset in employee tax planning. By staying aware of the tax implications surrounding stock options, Canadian employees can better plan their financial strategy and maximize the potential benefits offered through this incentive plan.